Hello. In this video, we're going to consider partnership allocations, specifically allocations related to non-recourse deductions. So first, let's talk about the basics when it comes to allocations with respect to partnership taxation. So remember that subchapter K of the income tax chapter of the Internal Revenue Code, right? The 700s deals with partnership taxation. And the general theme throughout subchapter K is Congress intended flexibility with respect to partnerships to be able to agree in terms of their affairs and how to structure economically the arrangement. And this includes allocations. Now, it's important to remember that allocations are different than distributions. The idea is that a partnership is subject to one level of taxation at the owner level. And every year, items of income, loss, gain, deduction, credit, all these things get allocated to the owners on paper, even if they don't actually receive the actual cash, or if let's say there's a profit, cash doesn't actually go out to them. That'd be a distribution. So we're talking about allocations, how it's allocated. And again, with the overarching theme of subchapter K, flexibility, we have to keep that in mind. So section 704A is where we find the general rules with respect to allocations. And we call this the distributive share. So whenever you see the phrase distributive share, always think about partnership allocations. They pretty much mean the same thing. We're talking about allocating items of income, loss, deduction, credit, gain, whatever it is, between or among the owners of the entity taxes of partnership. The general rule under section 704A, distributive share, is that we follow the partnership agreement. We follow whatever it says in the partnership agreement. Again, we're keeping with the idea of flexibility. Now, 704B sets the baseline for allocations to be respected. We have this idea of flexibility, but how much flexibility is allowed? Are we allowed unlimited? If we have two owners, 50-50, that contribute capital, right? Each contributes $100,000 of capital to a partnership and start a business, and they're 50-50 with respect to all things, except there's going to be a special allocation where one owner is allocated all the loss the first few years maybe, and then in the future, maybe then it's 50-50. Can we do that? Well, keeping in mind flexibility, the answer should be yes. However, there has to be some restriction on that because, as you know, in tax, there's lots of abuse by taxpayers. Think about tax shelters back in the 1970s, 1980s, and partnerships were a big player when it comes to tax shelters. So section 704B, the rules are that the allocations will be respected if the first thing, the key, again, keeping with flexibility, it's stated in the partnership agreement. So if it's not in the partnership agreement, we're going to have a big issue. If it's not in the partnership agreement, that's no. Then we follow what's called partners' interest in the partnership. And you're going to see this phrase a lot when it comes to the allocation rules. Partners' interest in the partnership. And we find the general rule under Reg 1.704-1B3, two little i's. And this is really a bunch of factors. We look at many different factors, how much capital is contributed, all these different items. And I'm going to label this with a box or rectangle as an A. Box, rectangle, A. So anytime that we cite this specific provision elsewhere, you're going to see referred to it as an A. An A. Okay. Now let's continue on. So you need to have in the partnership agreement, and according to 704B, you must also meet what's called substantial economic effect. Substantial economic effect. Now, substantial economic effect, keeping it as simple as possible, means that tax must match book. So going back to our example I mentioned earlier, if we have 50-50 owners with respect to capital contributions and everything with respect to the arrangement, how much time, energy is put into the business, except we're going to allocate losses to one of the owners just because we have flexibility. Well, as long as, and that's a tax allocation, as long as that follows the book, books, economics, then in general, it should be respected. There's there's additional exceptions to that. But the idea is that, okay, well, if we're allocating losses for tax purposes, then we need to allocate losses for book purposes. And if the business was to liquidate, guess what? That owner is not going to be able to recover whatever economic amounts of assets or cash are left in the business because they've taken those losses. So that's the general idea. Okay, that's the general idea of substantial economic effect. Now, again, for allocations to be respected, it must be in the partnership agreement. If it's not, then we go partner's interest in the partnership, and it must also be substantial economic effect. If it fails substantial economic effect, then guess what? Well, there's some special rules we got to go through. But I want to talk about the factors test, the partner's interest in the partnership. We do not want that to apply. And the reason why is because when it comes to this area of the tax law, you are, as a tax professional, you are drafting up an agreement between the owners. They want the allocations to be respected. You don't want to get into a malpractice issue by getting to a factors test where the IRS can come in and recharacterize any way they want and argue any way they want based on a number of factors. Factors means it's not certain. The courts could view it one way or the other. You want a safe harbor. You want certainty. Safe harbor means certainty. So any chance that we can to have certainty through a safe harbor is very important for purposes of this area of the law, the 704, the partnership allocations. Okay, so when it comes to substantial economic effect, let's just, for the rest of the presentation, rest of this video, let's assume that we do have it in the partnership agreement. It's in the partnership agreement. So when it comes to substantial economic effect, right, we meet the partnership agreement, so yes, we move down, and by the way, you'll see throughout this presentation I have some arrows. That's because we met one part, so we go to the next. So yes, it's in the partnership agreement. The allocation is specifically stated. It's not silent. So now we go down to substantial economic effect. Well, there's really three different areas that the allocation, the 704 regs break apart, different situations. The first is what we call the normal substantial economic effect, also known as SEE rules. So normal substantial economic effect rules, and that's found in Reg 1.704-1. This applies normally, normal allocations. The second, and what we're going to focus on in this presentation, non-recourse deductions. And I'll explain what those are in a few minutes. And this is found in Reg 1.704-2. The final one is what we call 704C, pre-contribution gain or loss. And that's found in Reg 1.704-3. Now, the pre-contribution gain or loss issue, that's not going to be relevant to this presentation. And the reason why is because we're talking about under the pre-contribution gain or loss, 704C, Reg 1.704-3. This is when a partner in the partnership contributes property, already existing property, where there's a built-in gain or loss. And then whenever there's depreciation or a gain or loss in the future when the partnership sells it, that has to be allocated a certain way. We're not going to be dealing with that. We're going to assume with respect to this analysis, we have no pre-contribution gain or loss assets. So no property was initially contributed by the partners where there's a difference between the basis and the book value at the time of contribution. We're going to assume that's not an issue. So we're going to be worrying about the normal SEE rules, the non-recourse deduction rules in this presentation. Now, at this video point, if you have not yet watched my normal SEE rule video where I go over substantial economic effect and I go through a map like this, a flow chart like this, please stop the video, watch that video right now, because learning about non-recourse deductions, you have to understand the normal SEE rules first, okay? So non-recourse deductions. Now, you'll notice I have not said, okay, we're not going to talk about normal SEE rules because it's integral to that. Again, if you haven't watched that yet, please stop the video and go back and watch that video. It's a separate video. It goes through that analysis of when an allocation that's going to be under the normal SEE rules will be respected under the safe harbors. We're focusing on non-recourse deductions. So this is what's going on under non-recourse deductions. So let's say you have a problem, your professor gives you a problem, or in practice, okay? If there is a non-recourse liability, and you might remember that non-recourse versus recourse liabilities simply mean that some partner or the partnership, somebody bears the economic risk of loss when it comes to the liability, meaning they're going to have to bear out of pocket if something happens where the property gets goes underwater, gets seized, gets sold, whatever, and there's not enough money to cover the amount of the liability, okay? And they have to pay to the bank or whoever's lending the money. So that's recourse. Recourse, again, someone bears that risk. So if the property went down in value, let's say the business forecloses on the property, then that person that bears the economic risk would have to make up the difference between the loss in value and the actual amount of the liability. Non-recourse, no one bears the risk, meaning that the lender actually bears the risk. So the idea here is if you have property, let's say that you have a non-recourse liability for, just keeping the numbers simple, $100,000. You use all that money to buy a building for $100,000. Building and land for $100,000. Economic downturn comes around, and now the building and land is worth $80,000. And let's say you haven't paid off any principal, you've just been paying off interest, and your business just decides to dissolve. Okay, well, if it's non-recourse, the lender bears the risk. It's going to be attached to the property because almost every non-recourse liability is attached to the property itself. So the bank is going to take over that, is going to take that property, that building and that land, which has a value of $80,000. Let's say they get $80,000, probably unrealistic. Let's just say they get $80,000. That $20,000 difference between the $80,000 they get and the $100,000 of liability amount they're owed, that is borne by the lender, the bank. That is what non-recourse is all about. Okay? Now, if there's a non-recourse liability, it's attached in the property, in a problem. If the adjusted basis at any time is greater than or equal to the liability, the adjusted basis of the property, you look at the tax basis, then we're applying the normal SCE rules, Reg 1.704-1. Again, go back to that video that I've already gone over. But if the adjusted basis is less than the amount of the non-recourse liability, we apply the rules for Reg 1.704-2, the non-recourse deduction rules, which have special rules. And here's why. Because as I mentioned in our example, right, the adjusted basis on our example of the building and land was $80,000, which was less than the amount of the liability, $100,000. So the idea is that if the business was to liquidate and the lender took over that building and land, they would have a $20,000 loss, the lender, to the lender. Now think about tax equaling book, substantial economic effect. If you're going to allocate loss with respect to this property going down in value, right, because through depreciation on the building, let's say, right, you've depreciated over years. Well, who's bearing that $20,000 of loss? Well, here the lender. Here the lender. So you're asking, okay, well, do we allocate depreciation deductions to the lender? Well, the answer is no. And the reason why is because of two Supreme Court cases known as Crane and Tufts. And Crane and Tufts, which are very important Supreme Court cases in tax jurisprudence, and you can watch my top 50 tax case videos, and I talk about both these cases. Crane and Tufts, what they establish is that when you borrow money, you are allowed to cost recovery deductions on the property as it goes. You don't have to pay it off and then get the benefit of the deductions. The owners do not. So keeping with that concept, that idea, we can't change that area of the tax jurisprudence. If we did, we'd have inconsistent system. So we keep with that, and we have to allocate the depreciation, the loss of economic use and value to the owners. And that's where the non-recourse deduction rules apply. Now, again, if our adjusted basis, let's say our adjusted basis in the property was $110,000 and our liability is $100,000, maybe because there were some improvements or something, well, then we're greater than or equal to, well, again, we're applying the SCE rules, the normal SCE rules, which we talked about in the previous video. But it's when it goes below. When it goes below the amount of liability, the adjusted basis goes below the liability, then we have to talk about non-recourse deductions, the special rules. All right. So as I mentioned, it's possible any area of the allocation rules to fall in the partner's interest of the partnership, Reg 1.704-1B3, two little i's, the factors test. We do not want that. We want to avoid that. We want a safe harbor. Well, there is a safe harbor when it comes to the non-recourse deductions. Reg 1.704-2. So I have an arrow drawn right here, and that's found, the safe harbor rules are found in Reg 1.704-2, specifically -2E, okay? So Reg 1.704-2E has a safe harbor, and that's what we're talking about right here. And what this safe harbor does is it establishes some requirements so that the allocation can be respected. So the first place we start is we go to the basic test back in Reg 1.704-1. So we're starting there, the basic test, okay? Reg 1.704-1B2, 2 little i's, B. And it's very important, your citations, because if you're like me, or if you have a professor like me, citations are extremely important in this area of the law. It's all about your path, how you show this analysis, your ordering, how you go about it, and showing the proper citations and the order you do things. That's the way you do this. And the way this video is set up is to show you the path you go through analyzing. So far what we've done, we've gone through and we said, okay, well, do we have a non-recourse liability on the property? Yes, we do. Well, is the adjusted basis greater than or equal to the liability? If so, we apply the normal SCE rules and we go to my other video. If not, if it's less than, if adjusted basis is less than, we apply the rest of the video. We continue. So in Reg 1.704-2E, we've got a safe harbor for the allocations of non-recourse deductions to be respected. First place we're starting is we're going through the old basic test of the SCE rules. Just follow with me. This is what we do. We start with the basic test and we ask, is the basic test met? Just to remember, again, if you need to go back to my other video, please do. There's 3 requirements of the basic test. The first is that the capital accounts are maintained in accordance with Reg 1.704-1B2 little IV. And this is basically GAAP, generally accepted accounting principles, following books. So the capital accounts are going to be maintained following books. Next is that according to the partnership agreement, positive capital accounts must be followed on liquidation. So if the business liquidates, you have to follow the positive capital account balances on liquidation. And finally, the third requirement is that there is an unlimited deficit restoration obligation. So unlimited deficit restoration. This basically says, hey, if you go negative in your capital account, you have to make that up unlimited amounts, which means that a limited partner is never going to have this is never going to be met for a limited partner or limited partnership, only general partnership. So if we meet all 3 of these requirements, then we are going to come over to some additional requirements of Reg 1.704-2E, some additional requirements. There's 2 additional requirements. But before we go over there, what if you fail it? What if you fail the basic test? Well, if you meet the first 2 requirements, but you fail the third, then remember the alternate test from Reg 1.704-1, the alternate test may be met. But if you fail requirement 1 or 2, doesn't matter about 3, requirement 1 or 2, well, guess what? Unfortunately, your non-recourse deduction allocation will not be respected and under the partnership agreement, and you're going to have to go with partners' interest of the partnership, and this is very bad because it's a factors test. And even more double trouble is the partners' interest in the partnership factors test is actually designed for factors that would relate to substantial economic effect. But as we talked about earlier, with non-recourse deductions, it's impossible to have substantial economic effect because tax cannot match book, because this idea that the lender is taking on the book risk, right? The loss, economic risk, economic loss. So you're really going to be in limbo. You do not want this as a serious malpractice. You want to avoid partners' interest in the partnership at all costs with respect to non-recourse deduction allocations. All right. So let's just continue down and say we met the first 2 requirements, but we fail the third. So let's say you're a limited partnership. You meet the first 2, but you fail the third. The alternate test from Reg 1.704-1 is still important. So that alternate test is found in Reg 1.704-1B2, 2 little i's, D. All right, and the 2 requirements you need, in addition to what you had in the basic test, right, those 2 requirements, following along, right, you also need to have a qualified income offset in the partnership agreement. So you need a qualified income offset in the agreement, in the partnership agreement. And the partner cannot go beyond zero or whatever deficit is committed, right? If the limited partner says, I'll go, if my balance goes negative 100, I will commit to giving back $100. It can't be unlimited though, because under state law, it's impossible for that to happen. If we meet both of these, then we go over to those additional requirements under Reg 1.704-2E. -2E. This is an E, by the way. Sorry, it's not a C. Let me make that clearer for you. -2E. If we do not meet the alternate test, then we fail either one of those requirements, then we go to A. Again, we do not want to be partners' interest in the partnership. That is what A denotes. Partners' interest in the partnership, that's bad. Okay, so if you meet all three requirements of the basic test, you go to the additional requirements. If you meet the first two requirements of the basic test but fail the third, you go to the alternate test. If you meet those requirements, then you go over to additional requirements. If you fail requirement 1 or 2 of the basic test or either of the requirements of the alternate test, then it's partners' interest in the partnership under Reg 1.704-1B3, 2 little i's, the factors, that's very bad. Okay, so now let's go to our additional requirements under Reg 1.704-2E. So we got 2 requirements. The first requirement is an interesting one. I'm going to explain this one in a moment. The allocation for non-recourse deductions, because the idea again is, hey, the lender is bearing the economic risk. Well, now the idea is keeping in mind the idea of flexibility. Well, we should be able theoretically to allocate any way we want, because again, economically, it's not going to work out that way. Well, as I mentioned at the beginning of this presentation, Congress wants flexibility, but they also don't want serious anti-abuse, where you're just allocating all the losses to one just for tax purposes. So we're keeping with that idea. So the first thing is that the allocation of the non-recourse deduction is within range of other allocations with respect to the partnership agreement that have substantial economic effect at any time. At any time is the key. Any time. It doesn't have to be this year or that year. Any time it would have substantial economic effect. Okay? The second requirement is the heart of all of this. It's by far the most important thing to keep in mind. The agreement, partnership agreement, contains what's called a minimum gain chargeback. And I'm going to explain that in a few minutes. If we meet both these requirements, then guess what? Our non-recourse deduction is going to be respected. The allocation will be respected, and that's good. The safe harbor is met, and we are happy because our clients are happy. But if either one fails, even with the other requirements met, unfortunately, the allocation is not going to be respected, and it's going to be partners' interest in the partnership, which again, we want to avoid at all costs because, hey, those were written for the substantial economic effect rules. All right. So again, keep in mind this. Number 2 is the heart of all of this, the minimum gain chargeback. Now, minimum gain chargeback is not the same as a qualified income offset. And actually, when you are in the non-recourse deduction rules, a QIO cannot be triggered. So when you are applying Reg 1.704-2, right, the adjusted basis is less than liability, yes, the QIO has to be there if you're under the alternate test. However, it's never going to be triggered if you're under those rules. If you're in Reg 1.704-1, it does. Remember, a qualified income offset only applies when there's unexpected events that occur. You think, oh yeah, the next year you're going to have income and you're able to offset and do things to keep your balance at 0 or negative for that limited partner. However, some unexpected turn of events, maybe there's a downturn in the economy comes around and the QIO is triggered. That's the only time QIO comes into play. Minimum gain chargeback, I'm going to explain later, but it is very different. So when we're doing non-recourse deductions, we have to keep track of some things. Okay, if you're doing an exam, keep track of all of these things, and each year, as you go through the analysis, keep a running tally, some tables of all these things. It's very important for your analysis. Not only just showing the path you've just gone through, but also showing these things. So each year, we're going to keep track of 4 things. Again, you want to make sure you make these clear. Make all these clear. First thing, of course, you want to keep track of capital accounts. You always keep track of capital accounts because remember, with all these rules, you have to follow substantial economic effect or try to get there at least. Tax is supposed to match books, and capital accounts are a way to show, hey, it matches books because book capital accounts. Next, you also want to keep track of the amount of the liability. If that liability goes up or down, you want to keep track of that. So in our example, our liability stayed at $100,000. Next, you also want to keep track of the book value and the adjusted basis of the asset that the liability is on or attached. So in our example, the building and the land, right, went from $180,000 in one situation, $110,000 in another. We want to keep track of that each year. And finally, you want to keep track of something called a partnership minimum gain, PMG, partnership minimum gain, and each partner share. I'm going to go in more detail on that in a moment. And each partner's share of the partnership minimum gain. You want to keep track of that each year. And the idea, again, this is the heart. This is the heart. The partnership minimum gain is the heart, and the minimum gain chargeback are the heart of the non-recourse deduction rules. It's essential that you have that in there. So here's the basic idea behind a PMG, a partnership minimum gain. Also called Tufts gain. Now this gets a little bit more involved in practice. You can have things with like distributions and stuff, but I'm going to give you the very basics. If you're taking my class, then all you need to understand is the basic idea of this. So if there's a triggering event where the PMG goes down in amount, and the most common one is when the property that the PMG relates, okay, the property where the non-recourse liability is used and secured, is sold or disposed of. If there's an event where PMG decreases, then we have to trigger, the partnership has to record an amount of partnership minimum gain, also called Tufts gain. And what you do is you take the non-recourse liability, the amount of the non-recourse liability, and that's going to equal your amount realized. So it's a section 1001 analysis, right? Amount realized minus adjusted basis. So the non-recourse liability equals the amount realized in that year, minus the adjusted basis that you've been keeping track of, and that gives us the partnership minimum gain. Then you're going to you're going to allocate each partner's share of the partnership minimum gain. And the idea is that's going to flow through on the K1 to each partner. So on the 1065 for the partnership, we're going to have a partnership minimum gain recorded, and then each partner's share is going to be then flown over, or it's going to flow over on the K1. That's essential. Now the character of the partnership minimum gain relates to the actual asset. So the character is going to match. Now the idea is as you go each year, you keep track of each partner's share, and if it's a basic, just let's say that we've disposed of the property or foreclosed on the property, you're just keeping track of each partner's share of that, and that's why it's not too difficult to do. That's why we're keeping track of all these things each year, and it makes it a lot easier. And that's really the idea. That's really the idea behind this. So however the non-recourse deductions were allocated between or among the partners, you keep track of that each year, and basically it needs to match. The partnership minimum gain means that it has to match. It's all about matching. Whatever benefit they got, they have to recover that later on the event, if there's an event that occurs. There's certain events that don't trigger that normally would, and these are found in the regs. I'm not going to go into them, like revaluation and waiver and different things like that. But the main one is if the property is disposed of or foreclosed, well, guess what? You're going to have to record partnership minimum gain for the partnerships, and each partner, whatever amount of benefit they got over the years when it was under Reg 1.704-2, that is their share of partnership minimum gain that has to be reported. All right, so this really summarizes everything. A few things I want to mention before we go. Remember, flexibility is the name of the game here. Must be in the partnership agreement. Then we go over substantial economic effect. Now, if it's a non-recourse deduction, and the way you know is that the adjusted basis is less than liability, we cannot meet the normal substantial economic effect rules under Reg 1.704-1. It's just impossible because tax cannot match book because guess what? The lender bears the risk. So then we go through this analysis. We first start with the basic test. Do we meet the basic test? Remember, basic test is all or nothing. You either meet it or you don't. If we don't meet the basic test and we meet the first two requirements, we go to the alternate test. Under the alternate test, if you meet both requirements in any year, it can be in any year. Doesn't have to be every year. Any year you meet these requirements. You are good. You are golden. If you meet the basic test or alternate test, you have the additional requirements. Has to be within the range. Now, I mentioned I was going to talk more about the range of other allocations. So you look in the partnership agreement. If there's any other allocations that happen with respect to the partners and partnership, you follow those. You follow those allocations. If there's multiple allocations that meet substantial economic effect in any year is the key, right? Remember, any year, then you put it within a range. So as long as it falls within the range of that partner, and there's another video that has a problem that goes through this. Please see that video for an example of this. Then you are good. You just cannot be outside that range. So it's basically you're within reasonable bounds. And then, of course, it has to have the minimum gain chargeback, which is the heart. Now, when you're doing this analysis, keep track of the capital counts, the liability amount, the book value, and the adjusted basis of the asset, as well as the PMG, and each partner share of the PMG each year. If you meet all of those, the allocation will be respected. If you fail the basic test, certain requirements, or the alternate test, or the additional requirements, it's going to be partner's interest of partnership, very bad. And then we also talked about how the partnership minimum gain and how it's the heart you match, right? Each partner share is the partner's partnership minimum gain, but their share is you look at the amounts they've gotten over the time and you keep track of that. All right, I hope you've enjoyed this video. Again, there's a problem that goes over this in more depth. Please see that video because that will help you tremendously in understanding non-recourse deductions, which are very, very difficult. Another thing is that some years, as I mentioned earlier, you can have SEE, substantial economic effect rules, Reg 1.704-1. Other years, Reg 1.704-2. Make sure you look at my substantial economic effect rules in the videos because basically with this topic, you can have 1 year, again, it applies one set of rules, the other set. So you need to go back and forth and understand both sets of these the substantial economic effect normal rules, and then the non-recourse deductions. So I hope you've enjoyed this video. Please see the problem videos that apply as well.